Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you a different video than the one I have been uploading lately. In this one I'm not going to discuss the analysis of any company in particular, but I want to show you some matters about investing in general. In this one specifically I want to discuss with you the structure that I use. If you have seen my previous videos, you know that it's divided in two aspects, qualitative and quantitative. The qualitative aspect includes past performance, management, competitive advantages, and financial position. And once I am happy that the company passes all these four measures, I go to the projections and the calculation of the intrinsic value. And if the price is attractive versus the intrinsic value, then I invest in the business. So in this specific video, I want to discuss competitive advantages. You may know that I am after durable competitive advantages, companies that have competitive advantages that last for many decades. And because this structure has been molded around the teachings of Warren Buffett and Charlie Munger, I want to share with you a video where Warren Buffett explains about competitive advantages. This video was filmed in 1995, so that's more than 25 years ago, and I think that competitive advantages are still as relevant today as they were in 1995. So let's have a look at it.
What are the fundamental rules of economics you used to make money for Berkshire?
The most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage. For any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing, and what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now. What are the key factors, and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
As you can see, Warren Buffett makes this analogy about a moat and the castle for competitive advantages and the business. So a moat is to a castle what a competitive advantage is to a business. And I think it's important in my strategy to invest in companies with competitive advantages or with moats. And the larger the moat, the better. It is possible to invest in companies with no competitive advantages, but let me show you a couple of examples of real-life numbers to explain why I think the way I think. So here, for example, we have a company that has no moat, and we can see here the past performance for the past 10 years of value. This is the value of the company, and this value was calculated at the moment. So this is not a retroactive analysis. And then we have the price. This is the price. In a company with no moat, the way that you should invest, I believe, is that you have to wait until there is enough margin, for example, in this case, from price to fair value, and you decide which margin is, let's say 30% or something like that. And at that point, you buy the company and you wait until, so at this point you buy the company and you wait until the price reaches fair value. So in this case, it could have been around here, or you would have to wait all the way up to now to sell. So when you buy at an enough margin and you sell at no margin, then you're making the difference, the profit. Your return, in this case, is going to be the difference between the price you paid and the price you sold it, but the value of the business stays the same. So this one has been hovering at around 50. This type of strategy has some problems. One of them is that you rely on the price reaching fair value, so that you're relying on something that is depends on the emotions of the market. Because you are investing in a company that's not creating value, then the longer you stay in this company until you reach your price appreciation, let's say, the smaller is going to be the return. Companies that have no competitive advantages like this one have are not creating value because the return on investment is equal to the weighted average cost of capital. So another problem of investing like this is that you will have higher activity because you will have to buy and sell, and repeat that over and over again. And that, of course, is a very tax inefficient way of investing. It also demands lots of time and work from your side, because the moment you sell, you will have to find another opportunity to put that money to work and repeat the process. Well, let's say what happens if you invest in a company with a durable moat, which is the strategy that I prefer. This type of company, what happens is that the intrinsic value will tend to grow as the time passes by. Why? Because the company creates value, because the return on investment on this company is higher than the weighted average cost of capital. And if you have a high return, of course, you're going to have lots of competitors trying to get into the same business that you. And if you don't have any moat, that return is going to be competed away. But a company that, like this one I'm illustrating here, that has been growing value over a 10-year time in this case, means that they have some type of competitive advantage because they still keep creating value. They keep having returns higher than the weighted average cost of capital. And this is the type of business I want to invest in, because if I buy them somewhere here, when they are not necessarily, they have to be very undervalued. They can be even fairly valued. So I can pay fair value and still I'm going to make a good return, because I'm going to wait. I'm going to write this creation of value. So that means that my return is going to be dependent on the increase on intrinsic value. So as long as this company increases value, I am going to stay with it, and I'm not going to sell it. So it's a much more efficient way of investing, tax-wise. It's also you don't need to be in the search of new opportunities all the time, because once you find your company and the company is creating value, then that's it. You can hold it forever. And this is where the buy and hold strategy comes into place. It's the type of strategy preferred by Warren Buffett. But some people say that the buy and hold strategy doesn't work. And of course, that strategy doesn't work if you invest in a company with no moat, because you will have to keep selling and buying new opportunities. But if you use it in a business that creates value, the buy and hold is a really very sound strategy, and this is the one I am preferring. So that is why when I look into a business, and in part of the qualities that I'm looking for is, as I showed you, the competitive advantages. And I put a lot of emphasis in trying to find businesses with competitive advantages because my strategy depends on that. There's one thing that is really problematic, and is that if you think that you're investing in a company with a durable moat, but you are not. So if you are mistaken in your assessment, you will be investing in a company for the long term, in a company that's not creating value. And that's a big mistake. So you want to make sure that you invest in, you put all the effort in understanding the moat of the company. And once you understand the moat and you know that the value of the company is roughly what the price that is being offered, then you buy and hold, possibly forever. So this type of strategy is only suitable for people that want to do the fundamental analysis, that have long-term view, because as you see, the value is created over a long period of time, so you will have to wait. It's suitable also for people that's patient, that wants to wait until the opportunity presents itself. And once you have that good opportunity, you act on it and you forget. Well, you have to keep an eye on the company, of course, because you want to make sure that the company creates value. And as long as it's creating value, you are going to hold it. The good thing about this is that you have less competition, because normally in Wall Street, investors are quite, even though they say they are long-term oriented, they are not. They are short-term oriented, and especially fund managers. They are short-term oriented by nature, because the moment that they stop performing in the short term, all the clients will leave. So you have less competition if you have this type of structure, this type of strategy. And having less competition, of course, is your competitive. This is your competitive advantage. The fact that you can have what's called time arbitrage. So that's it. I wanted to give you a quick explanation of that today. I hope that you liked the video. If you liked it, please give it a like, and don't forget to subscribe to the channel, and also press the bell if you want to get notified when I upload a new video. So I hope to see you next week for another valuation and long video as I normally do. Until then, thanks very much for watching, and see you then. Bye bye.